Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Strategas president and head of portfolio strategy, Nicholas Bohnsack, to talk all things markets. Nick, how are you doing today?
I'm doing very well, my friend. How are you?
I'm doing really well. Thanks for asking, and thrilled to talk to you today. I think we find ourselves at a really interesting moment. We're in the midst of another one of these rallies inside of a bear market, and so the question always becomes: is this the start of something new? Or is this nothing more than a counter trend rally that will ultimately reverse lower? I'm curious, how do you see the market as it stands today, and what sort of framework are you using to evaluate the market that we're in right now?
Now, listen, that's a great question, Ross, and I think it's an important place to start the conversation. As you know, we have been somewhat suspicious about the durability of what we view as being counter trend rallies, particularly in the equity market. And I think that proved to be the case over the summer, and even in light of some of these sort of bullish economic signposts that you mentioned in recent weeks, we remain equally suspicious about the durability of the current move. Predicated in no small part, perhaps, by China maybe easing up on some of its anti-COVID restrictions. But ultimately, we have defaulted back to a framework that we think has been very helpful in understanding the strength underpinning this market, and we've used it for the better part of this year. And it's really a very simple three-part exercise. The first is, where are we on inflation? Have inflation expectations topped? Have inflation levels in terms of rates of change started to roll over? And how quickly might those levels start to arrest back to something that appears acceptable for policymakers to become less aggressive in terms of tightening financial conditions? So that's one, inflation in a watchword. The second is really, have we brought fundamental expectations, which is to say corporate profits and revenues and profitability, in line with price? And the prism of valuation, particularly elevated valuations, we continue to believe looms large over this equity framework, and we haven't necessarily seen the pullback in expectations for corporate profits as we look out to 2023, and that's despite the fact that most economists believe we'll be in a recession. So that seems not to be in concert one with the other. And then I think thirdly, and this really speaks to the durability of any particular move we see in the equity market or any strengthening we see in the economy, is what are those organic drivers of growth that would call private capital to be invested in the economy, whether it's free cash flow from the operating side of the ledger or invested capital from private hands. So we're watching inflation very closely, Ross. We're watching valuations, and then we're watching what those durable organic drivers of growth might be.
I think that makes a lot of sense, and I think it's a really smart framework to use to break down what has ultimately been a pretty confusing market over the last 6 to 12 months. And so without further ado, let's tackle a few of those items you mentioned. So number one, has inflation peaked? And then almost as importantly, how quickly can it decelerate to get the Fed to a place where they're comfortable easing policy? Number two, what is your outlook for corporate profits next year? And do valuations as they stand today, properly reflect what you all see as a weakening fundamental environment and an earnings contraction in 2023?
Yeah, well, on the inflation side, I think there's a couple of different really important threads to pull on. I think there's a reasonable case to make that the absolute level rates of change have peaked. We saw some of the headline consumer price indices get up above 9%. Those have seemed to start to arrest lower, which is really important. But again, when you see prices increasing 5, 6, even 7%, depending on how you want to sort of cut through these things, that comes at a real expense to the consumer. It comes at a real expense to business. And so the Fed will want to see those levels lower. And I think this is what invites the historical analog of the 1970s, is that the Fed would view it as a policy risk, not that they cause a recession, but that they adjudicate monetary policy in such a way as that when they pause or even start to ease, that inflation doesn't come roaring back. And in the 70s, or looking back at the 70s, they refer to that as a stop and go monetary policy, when the Fed is very loath to repeat that. And so I think what we're very likely to see, and as Chair Powell perhaps intimated yesterday in his press conference, is that the Fed may ease up a little bit on the rate of increasing the rate at which they're increasing the policy rate. They're likely to sort of continue at pace with respect to quantitative tightening, and so it invites in the second part of your question, which, well, what is that level at which the Fed would be willing to declare victory. Some members of the Federal Reserve, not the chair, have spoken specifically about the 2% threshold. And of course, does that mean 2% like 2.0, or does that mean 2.9? And I think, one of the things we would be concerned about is that if they are taking a more strictly constructionalist view and they want to get inflation back to 2%, the cost of those last 100 or 200 basis points, going from a 4% rate of inflation to a 3% or a 2%, becomes increasingly costly, and it would likely be accompanied, by some significant shakeout amongst businesses, particularly the labor market. And so that invites the second piece of the Fed's mandate, to the framework. And so the Fed is in a very interesting spot here. Our view is that they're going to slowly soften the rate at which they're raising interest rates, and then take a considerable period of time to observe the landscape and the impact that may have. But progress is decidedly being made. I think the second part of your question, as it relates to corporate profits, is as interesting as the first, which there seems to be some incongruous points of observation between this idea that we will absolutely find ourselves in a recession, if not in the United States, globally next year, and this anticipation that corporate profits will grow. This is confusing, I think, for a lot of folks. There's something to be said that inflation creates this money illusion where the level of revenue and the level of corporate profits remain elevated relative to what you might consider is the percentage declines that would be associated with recession. I think when you incorporate that, it looks like the economy is not being as damaged as much. What we're very focused on is corporate profit margins and the level of profitability. And there we have started to see some real acute pain across the landscape in almost all sectors, with the exception of energy and some of the other commodity related industries. And so we would anticipate that profit expectations continue to move lower as corporate guidance continues to soften in an operating environment where they are also pressed with increasing costs. And I think for our investors, it's important to pay particular attention to the strength of the labor market as well. Whether the Fed wants to get back to 2%, that comes at a cost, whether corporations want to return to higher levels of profitability. But we believe that earning estimates need to come lower, and with it, likely, so does the stock market.
That is a tremendous summation of where we find ourselves. And I think, advice that urges caution in the midst of what you all view as another counter-trend rally, and with more economic weakness on the horizon. So, Nick, I want to thank you so much for your time. It's been really insightful, and hopefully we'll get to talk to you again sometime in the new year. Thank you.
We appreciate it, Ross. Thank you.